Imagine a financial earthquake shaking one of the world's most stable economies. Last week, Japan's government bond market was gripped by its most severe turmoil in decades. A staggering wave of selling wiped out $41 billion in value, sending shockwaves far beyond its borders. Traders described it as one of the most chaotic trading days in years, reigniting concerns about the fiscal health of the world's most indebted developed nation. The catalyst? A pledge from Prime Minister Sanai Takaichi to suspend the consumption tax on food for 2 years, ahead of a snap election. With no clear plan to fund the estimated 5 trillion yen annual revenue loss, investors panicked, dumping longer-dated Japanese government bonds en masse.
Record yields rock markets. The numbers tell a stark story of the chaos. The 40-year bond yield soared past 4% for the first time since its debut in 2007, hitting an astonishing 4.21%. This marks the first time any Japanese government bond has breached that threshold in over 3 decades. The 30-year yield wasn't far behind, jumping nearly 26.5 basis points in a single session to hit a record 3.875%. while the 20-year yield climbed above 3.4%. As per Meltdown, a fund manager at Pacific Investment Management Co., put it, a yield increase of 25 basis points in a single session is something that, for a bond market veteran, seems almost inconceivable. A weak auction of 20-year bonds earlier in the week only fanned the flames, creating a vicious cycle of selling, heightened anxiety, and more selling. Dealers reported a shocking lack of buyers, with one strategist at Nomura Securities grimly noting that no one is willing to buy or attempt to catch this falling knife.
Global contagion spreads.
The tremors weren't confined to Japan. The turmoil quickly spread across the globe. U.S. 10-year Treasury yields surged to their highest level since late August at 4.31%, while 30-year yields reached 4.91%. This is significant because Japan is the largest foreign holder of U.S. Treasuries, with approximately $1.1 trillion in holdings. Higher domestic yields in Japan could drastically reduce their demand for American debt. The volatility has drawn unsettling comparisons to the 2022 crisis that engulfed British gilt markets after then Prime Minister Liz Truss's unfunded tax cuts. Japan's public debt currently stands at an eye-watering 230% of GDP, the highest among developed nations, and nearly 25% of its budget is now allocated solely to servicing that debt. With the Bank of Japan holding rates at 0.75% and gradually reducing its bond purchases, a critical question looms: who will absorb new issuance when confidence is so fragile?
All eyes on Wednesday's auction.
All eyes now turn to a crucial 40-year bond option scheduled for Wednesday, January 28th. With approximately 400 billion yen on offer, this sale will serve as a critical test of investor appetite following last week's historic turmoil. Prime Minister Takaichi, for her part, has pushed back against concerns, denying that her administration would issue new deficit-covering bonds to fund the tax cut. She stated, "If it is limited to 2 years, we can certainly manage without issuing special deficit financing bonds." Yet, despite her assurances, investors remain deeply wary. As one analyst aptly summarized, the market no longer views super-long Japanese government bonds as stable assets. They are being recalibrated to align with global fiscal risk assessments. Japan's financial stability, and perhaps global markets, hang in the balance.